This is Shadowline News, bringing you in-depth analysis on the stories that matter. Kenya's monetary policymakers are confronting mounting economic pressures as the country's currency faces significant headwinds in an increasingly challenging global environment. The Kenyan shilling is experiencing sustained pressure against major currencies, with expert forecasts indicating a likely depreciation of around 4.6% against the US dollar, potentially trading between 120.9 and 140.5 shillings per dollar as economic fundamentals continue to strain. This currency weakness stems from Kenya's persistent current account deficit and high demand for US dollars, driven by the country's position as a net importer of essential commodities. The situation reflects broader structural challenges facing East Africa's largest economy as it navigates a perfect storm of global economic headwinds, including elevated oil prices, supply chain disruptions, and tightening monetary policies in major economies. For ordinary Kenyans, these currency pressures translate directly into higher costs for essential imports. Fuel prices, cooking oil, and other imported necessities have become increasingly expensive, straining household budgets and creating social tensions. This burden falls disproportionately on lower-income families who spend larger portions of their income on basic necessities, highlighting the human cost of macroeconomic instability. The Central Bank of Kenya finds itself in a familiar yet challenging position, maintaining relatively high interest rates to support the shilling and control inflation. However, this monetary tightening creates its own pressures, potentially dampening economic growth at a time when many sectors are still building resilience following global disruptions. The central bank's balancing act between currency stability and growth support reflects the complex trade-offs facing emerging market policymakers worldwide. Historical precedent offers both guidance and caution for Kenya's current approach. During the 2011 financial crisis, when Kenya faced similar currency pressures, aggressive policy measures successfully stabilized the shilling but led to a period of reduced investment and slower economic growth. This experience demonstrates that while monetary interventions can achieve currency stability, they often come with significant economic costs that persist long after the immediate crisis passes. Kenya's situation is not unique across the African continent, where many nations are grappling with similar combinations of debt burdens, inflation, and deteriorating terms of trade. However, Kenya's position as a regional economic hub amplifies the significance of its challenges. As a key player in the East African community, Kenya's economic health directly influences regional trade patterns and integration efforts. Neighboring countries with strong commercial ties to Kenya are monitoring these developments closely, understanding that financial instability can spread rapidly through established economic corridors. The implications extend beyond regional boundaries to international markets and development partnerships. Ongoing discussions with the International Monetary Fund about lending programs remain critical in shaping Kenya's fiscal and monetary policy responses. International investors and multilateral lenders are closely watching how Kenya manages these pressures, as the country's policy responses will significantly influence future investment flows and economic confidence. Investor sentiment has become increasingly sensitive to political stability and policy consistency, factors that directly affect capital inflows essential for currency support. Any reduction in foreign investment could further weaken the shilling, creating a self-reinforcing cycle of currency pressure and reduced confidence. This dynamic places additional pressure on policymakers to maintain both economic orthodoxy and political stability. The business community, particularly small and medium enterprises that form the backbone of Kenya's economy, faces mounting challenges from this environment. Higher borrowing costs resulting from elevated interest rates, combined with volatile exchange rates, create operational difficulties for businesses dependent on imported inputs. Manufacturing sectors are particularly vulnerable, as input cost volatility makes planning and pricing increasingly difficult. For importers and exporters, adapting to this new reality requires sophisticated risk management strategies. Many businesses are being forced to build larger financial buffers and develop more flexible supply chain arrangements to cope with currency volatility. These adaptations, while necessary, often reduce efficiency and increase costs, ultimately affecting competitiveness. The need to rebuild and maintain adequate foreign exchange reserves remains paramount for Kenya's economic stability. This requires a coordinated approach focusing on export promotion, maximizing remittance flows, and attracting foreign direct investment. The government's fiscal discipline plays a crucial role in this effort, as excessive spending can undermine currency stability and complicate monetary policy implementation. Kenya's policymakers must also balance the imperative of currency stability with maintaining social spending programs that many citizens depend upon. This creates a particularly complex challenge, as reducing government expenditure might help fiscal indicators but could exacerbate social tensions if essential services are affected. The political economy of adjustment measures adds another layer of complexity to an already difficult situation. Looking ahead, the effectiveness of monetary policy measures will likely depend on broader structural reforms and fiscal coordination. Kenya's ability to enhance its export capacity, diversify its economic base, and improve productivity will be crucial for long-term currency stability. These longer-term improvements are essential for reducing the economy's vulnerability to external shocks. The global economic environment continues to present both opportunities and risks for Kenya's recovery efforts. While some commodity prices have stabilized, uncertainty remains high due to geopolitical tensions, climate-related disruptions, and evolving monetary policies in major economies. These external factors will continue to influence Kenya's policy options and economic outcomes. Kenya's experience offers important lessons for other emerging markets facing similar challenges. The country's approach to balancing multiple economic objectives while maintaining policy credibility provides insights into the practical difficulties of economic management in volatile global conditions. The emphasis on gradual policy adjustments rather than dramatic interventions suggests a more nuanced understanding of the relationship between monetary policy and economic growth. The success of Kenya's economic management will ultimately depend on its ability to maintain confidence while implementing necessary adjustments. This requires clear communication with markets, consistent policy implementation, and careful attention to both domestic conditions and global developments. The central bank's commitment to data-driven decision-making provides a framework for responsive management, but execution will be crucial. As Kenya continues navigating these economic crossroads, the experiences of recent years provide valuable insights into the challenges and opportunities ahead. The country's ability to manage currency pressures while supporting economic growth will not only determine its own trajectory, but could also set important precedents for how emerging markets respond to similar challenges in an increasingly uncertain global environment. The path forward requires sustained attention to both immediate stabilization needs and longer-term structural improvements. Kenya's policymakers face the ongoing challenge of maintaining economic stability while creating conditions for sustainable growth, a balance that will define the country's economic future in the years ahead. This has been Shadowline News. Stay informed, stay ahead.